let's talk about a full reserve banking system on Bitcoin. Let's talk about how it works, how it operates, what its limitations are. Because for me, I struggle with full reserve, even though I fully understand why people are anti-fractional reserve, but I struggle with it, and I sometimes think it perhaps puts limitations on humans and what humans want to do. Like a question I've asked a few economists previously is that uh, despite the negative consequences of this credit-based system, this credit-based system on crack that we've had over this last couple of decades, has it led to humans advancing further? Has the availability of cheap credit meant we have advanced and I think it's on specific measures, but have we advanced our technical evolution because companies have had access to cheap credit? And I'm almost certain it's true, but it's come with these trade-offs. I feel like a fully fractional reserve system means it's harder to get credit because it's more expensive, and therefore, we're going to have less competition with the market, less development. But maybe that's a good thing.
Yeah, so I think that, when you're thinking about a full reserve system and, what some of the trade-offs are for it, I think, when you break this down, number one, and I think it's important to think about this problem or potential problem. It's theoretical in nature at this point, but I think that it'll probably be one of the major forms of criticism of Bitcoin as it continues to scale, not in the way that it is now, but in a new form. Because it was a major criticism against full reserve economics proponents. So it was 1960, Milton Friedman did this pretty well-known estimate of if the world existed on a full reserve gold standard, then about 2.5% of the net national product, which is very similar to GDP, it's a little bit less, it removes depreciation, but probably say 2% of GDP would have been committed towards gold. Now, for a global system, 2% is no small amount. And that was a huge argument that a lot of economists had against, any sort of full reserve system, was they're if we were to do that, so much of our productive capacity would be focused on it. Now, on the Bitcoin side of things, people would very quickly be we're expending this energy to secure a monetary network, and that's incredibly valuable, and we don't want to cut costs around that. And while I completely understand that argument, number one, I think it's important to understand this so that you have a counter argument. Number two, I think that there's going to be some form of optimization that'll exist around that. Because the way that people need to think about this question, and I haven't formed an answer to it, this is one of those open-ended questions that I got to in my writing, but it's just okay, so if the cost of producing the monetary asset was one of the primary criticisms of the gold standard, then that's going to be one of the primary criticisms of the Bitcoin standard. And when we think about that question, it's just well, we already know that the cost to attack the Bitcoin network, I think, and there's different estimates out there, and there's there's that cost to attack website or whatever. It's $40 billion and run rate 30 million a day or something.
Yeah, but it also, you have to consider the practicality of it as well. So there's the economic cost, but the reality of can you secure the ASICs? So it's even more complicated than that.
Totally. Yeah. So there's the quantification of if we had everything in front of us tomorrow and supply chains were capable of producing it, then this is what it would cost theoretically.
I actually think we're at that point now where it's almost unfeasible for it to happen.
Right. And because you and I talked a little bit about this, and I agree on the last podcast, and I agree. I think it would be incredibly, I'm not going to say impossible, but it'd be incredibly hard to execute. And then just getting the governments to actually organize to do that without anybody defecting.
Yeah, I mean, coordination's difficult, accumulation of the ASICs, the hash rates so you could do it.
Yeah.
Being able to deploy it, do that in stealth mode so people don't realize you're attacking, because once they realize it also, then there will be defense and reactions. So I think we're at the point where it's not that possible to do it now.
Right. So that leads to the next question. And that question is okay, so what is the optimal security budget for Bitcoin? What is the amount of energy, labor, capital that we're expending to secure this network that we need to protect it from any sort of attack on the network? And, nothing more than that would matter. And I think that there's a lot more research that needs to go into that, because that'll be a huge question. If we have a full reserve standard, and if, what we're saying right now, if it's already so hard to attack the network, and, Bitcoin goes 100x in price over the next 3 decades, then what's hash rate going to go? how much unnecessary capacity is ultimately going to be sitting there? And once again, comes down to what's unnecessary. But if we're already getting close to a point where its security budget is getting there, maybe it needs to double, and then we're 100% certain. Maybe it needs to triple. Whatever that number is, we're likely to see some sort of point where it's probably far beyond, in terms of hash rate, anything that we'd ever actually need to protect it from, security at that level. There's a lot of other attack vectors that we could talk about, but just within focus of this area. Yeah. And I think that's kind of one of the interesting arguments, because when you think about that from a full reserve system, that's probably going to be used as justification for fractional reserve. And people are going to say, like, okay, we have this network that is consuming all this energy. What if we start using these other tokens that don't have as high cost of energy or something? And banks would be like, look, it's all backed by Bitcoin. We're just, securing it on a different side of the network, and we're holding it here. So, like, if we have a competing form of monetary media, I could definitely see some sort of emergence coming for that reason. And people are going to say, like, use fiduciary media, use this credit-backed money of these banking institutions. That way we're saving on costs for a lot of other things. And it's not as if there is no merit to that argument either. And the question is like, well, if it was let's assume it was some sort of free banking system. We got to kill this motherfucker.
Don't use Eric's book.
Yeah.
Motherfucker, how does it know?
That was your gift.
Sorry. It's the eighth property. Storage fucking fly. How does a fly do that? That book was flying through the air silently, and that fucking fly knew. Anyway.
Sorry. Oh, he's coming back to you now, man. Oh man, we got to get rid of this thing.
We won't. He's smart.
Be smart.
You can't edit this out.
We can't edit. Eric just tried to get it, and he was like 2 meters away from it.
You need the chopsticks, Mr. Miyagi. Do you know that? Have you even seen the?
I mean, I've not seen it. But
what?
I mean, I've not. I know the. Did you get? I've seen the. I know the reference, but I've not seen.
You've not seen. Oh,
have you, Eric?
No.
Yeah. See, it's a generational.
Oh yeah, but hold on. Have you seen Back to the Future?
No.
Thank you.
Yeah,
we're like pretty much the same age.
Cool.
Eric's a couple of years younger.
Have you not seen Back to the Future?
I try to watch those old movies sometimes, and
they're not old.
And I'm just like,
old movies are like Gone with the Wind's an old movie.
I'm just like bored.
What? Gone with the Wind is an old movie. Back to the Future's not an old movie. They've not seen The Karate Kid, Jeremy.
Then they have no discipline.
They have bad parents and no discipline. All right. Do you consider The Matrix an old movie?
Oh, no.
Phew.
I grew up on that shit.
Well, that's like you calling Back to the
Right.
Future an old movie.
Yeah.
God, I'm too old for this shit.
Like my cousins who were like early 20s would call The Matrix an old movie.
Yeah.
Yeah.
God, man, I'm so old.
I mean, it came out when I was 8.
yeah.
That's quite old.
Yeah.
Did Back to
it
the
is
Future? Were you
old.
alive when Back to the Future came out?
I don't know what year was it released.
Got to be the 70s, 80s?
Well, definitely not then. 85. Yeah, no,
Jesus, that's
not
fair.
even close.
So look up when the first Alien came out, because you've seen the first Alien.
I have, yeah, but my dad was on that one.
Your dad should have been on Back to the Future. Your dad hasn't done his duty as a father.
I mean, that was 1979.
Yeah, I was born in the 70s.
Holy shit.
We've taken a big sidetrack here.
I know. I'm an old man. Well, Eric insisted on whiskey. That means two things are happening. I'm not really paying any attention to anything he's saying, and I'm thinking about
I've got a
movies.
question on this anyway.
Yeah.
This can get us back on it. So in the current system, we've got a money supply that's elastic and a credit system on top of that.
Yeah.
What happens when you go to a money system that is inelastic, but you can have some credit expansion on top of it?
Yeah.
Like, what does that change?
Yeah.
Well, hold on. Where is the credit expansion? Are you on about because the banks are issuing their own notes?
Well, not even the banks. Like you can never stop people borrowing. So that does expand.
You have
That's
a
credit expansion.
So think about it this way.
Okay.
You could lend gold directly, and that would be credit, right?
Yeah.
Or you can issue notes, and that would be credit. But you could only issue notes to the full amount of gold that you have in reserves. So
If you're honest.
if you're honest, yeah. So just like by way of example, if you were to take all the gold you had in reserves and directly lend it versus you represented it with paper notes and then you lent that would be the same amount of credit issuance. Credit is money, but there's no credit expansion from the money. But fiduciary media is a step beyond that. So it's like, okay, we took this gold, we're issuing notes on top of it, And now we've issued credit for that. Everybody is using our notes as money. So we can issue notes beyond that. And now we can print a bunch of new notes and just start issuing loans with notes directly without any gold. And like that's how it would emerge, is they get people to trust in the paper, and then they start issuing notes on top of that. And that system worked because most people would be keeping their gold within the system and not, drawing on it all the time. And that's ultimately how the trust in that type of system would emerge. So does that kind of like answer the question?
I think so, but
So there's credit that's being issued through the money itself once you have fiduciary media come up. And that's beyond the amount of just, because you had another layer to that question.
Well, I was kind of going to, like, if I said to you, I'll buy you a beer tonight.
Yep.
I can't figure this out.
Yeah.
This is something that I've been trying to figure out for so long. I've been speaking to Ben about it loads. But like, it's the idea of me, it's like me lending you £10, right? It's credit. You can go out to the pub tonight and buy beer.
Yep.
And so that changes prices. And I paid you £10, but I was never concerned about having that £10 in my bank because that's like part of my savings. And so you owe me £10 now, but it's increased that money supply because you've spent it.
Yeah, I guess like, you would have a certain amount of credit. Yeah. So like any sort of credit that you could issue out of that. Yeah. Sure. That would make sense. But like if you're doing it directly through the money supply, it's different because it's much easier to issue that credit. So like when you're talking about like just credit that could technically exist within the economy, I guess like when I'm talking about structuring it through like a banking system where it emerges out of a banking system, then yeah, like your analogy, like if you just, bought somebody a beer or somebody gave you a beer and you're going to pay for it later or something, then, theoretically, yeah. So like the way to think about it is like any sort of money that you would have to spend to like front somebody on credit, that's money that moves from somebody else, right? So it'd be like if you and I go to a bar and the bartender is not going to sit there and say, I'll give you the beer. He's going to say like, somebody give me money. And I'll be like, all right, I'll cover you. So like any sort of lending, so like all of those reserves that are in the bank that are now being lent out as credit, those are all reserves that nobody's sitting around spending because they're in the bank.
Yeah.
So like that's why it's not monetary expansion. Does that make sense?
Yeah.
Yeah.
I think so.
Okay, are you clear?
No, but
that's fine. But okay, one thing I want to say, I don't think we're ever going to have a full reserve system. To have a full reserve banking system will only happen, I think, with regulation. And the kind of people who want a free banking or more of a free market era are the kind of people who are kind of anti-regulation. Yeah. So I just don't think it happens. I think a fractional reserve free banking market will emerge from a Bitcoin era where we have smaller state. I think we're trying to consider a scenario that isn't possible. And actually, do you know what I think happens? It's quite interesting because I'm with Hal on this. I think I put it in, did I? It was in your paper. I think you referred to what Hal Finney said. But there is that other issue that the Bitcoin denomination, there probably isn't enough Bitcoin that exists denominated available to have a fully functioning economy. So unless you get into microsats, I don't know how they work, but that is also a potential issue. I just don't think it happens. I think what you will have is you'll have a free banking option where banks will hold Bitcoin and they'll issue their own eCash, Fedi Mint style. And I think that's what we will have. And that will be based on reputation and risk. I just see that's the scenario we go to.
So here's what I think is the key limitation. And the question becomes, going back to the point earlier, so paper, you needed people to have trust in a note. People needed to know like that note represents gold before the system of fiduciary media could ever emerge on top of that. Before, there was just a bunch of notes that represented full reserves. And then eventually it got to a point where like everybody's trading our notes. They trust our notes. Our notes have now become money. We can issue a lot more of our notes and just issue loans directly from that. Now we're expanding fiduciary media within the economy. And once you kind of get to that level, the question is will Bitcoin be able to make that jump?
Well, hold on. Why were they able to issue those notes?
Because people trusted that they were redeemable and they set up legal contracts for that.
But in the Bitcoin world, we will have proof of reserves, which creates a new level of trust.
So that'll be that proof of reserves is better. And I write a little bit like the proof of reserves on the asset side is great.
Yeah.
The question is the liability side. Now, for like digitally native issued liabilities that we can measure, that's great, but there's going to be so many things that aren't that. Anything that's happening in the real world requires audits. And like that.
Well, I think over time, trust. I think over time things build up trust and reputation, and I think there's a combination of proof of reserves, reputation, trust, history.
Yeah.
Fucking fly. Do we need a fly break? You're not going to get that.
Oh,
you nearly did. You need the chopsticks. I can't believe you've not seen the fucking Karate Kid. Honestly, do you know where you miss out? I've not seen the Karate Kid.
The fly is literally right here.
You miss out on the kind of what's it called? Cobra Kai, which is the new version of the Karate Kid that's come out on YouTube, which is a YouTube series, which is the Karate Kid 20 years later, but with the same characters, and it's fucking hilarious. It's genuinely brilliant. The premise sounds shit. I haven't seen anyone seen the original Karate Kid. It doesn't get, oh, fuck you. It's basically, do you know what it's like? It's like in 20 years when you're my age, they do like some Harry Potter shit, and you'll be like, oh my God, it's so cool.
I mean, I've not even seen all the Harry Potters.
I haven't seen any of them. Okay.
All right, let me finish this point because this one's important. Like, I think that the key limitation on whether or not we will see a free banking system emerge is whether or not there's ultimately demand from borrowers to want to use something other than directly Bitcoin. Because if they want to use directly Bitcoin, then you're never going to get any sort of note that people trust that they can ultimately start issuing beyond the amount of reserves that they have. That'll be a key limitation because a lot of people say like, well, you're giving me money. We can send it instantly over the Lightning Network. There's no need for you to create a note. I'm just going to accept that loan. And then that'll just completely restrain the system from ever getting to the point of like, we have these notes, we trust the notes, we can expand these beyond a certain amount.
Yeah.
So like that's going to be a huge point of contention. And, I was talking to like Farrington a little bit about this, but one point that I think could be a way that ultimately emerges is like, well, why do banks want that kind of a system? And it's because in the current system, the reserves for the money that they issue, if it's like full reserve when they're lending, are a lot more expensive to them, right? Because they're going to have to pay depositors a certain rate on that. When they're issuing new money, when they're issuing fiduciary media, that is all coming at like nearly zero cost to them. And they can pass on a lot of that to depositors. And that'll be one reason that they would want to be issuing some form of fiduciary media is say like, okay, we can pay higher interest rates, we can gain market share, we can attract more capital from our depositors. So like that'll be one big piece for why they would want it. So the question becomes, well, why would borrowers want to ultimately accept those? Because they need to have the other end of it too. If they're going to pay the interest to the other people, well, they've got to have the borrowers come in who are going to accept something other than directly Bitcoin on Lightning. So like if those guys are going to come in, I think one way they do that, and it'd probably be some sort of like programs where they'd say like, okay, we're going to issue some sort of like, here's a loan we'd give you in Bitcoin, and we're going to have all these terms associated with it. We'll give you better terms if you take our note. And they're going to attract borrowers to and get cheaper money because it's no cost to them. They can immediately just hit their bottom line with all of this and gain market share. So they're probably going to start creating programs to attract depositors where they effectively are passing along the benefits of their newly issued money a little bit to their depositors through better terms as well. That's probably one way I could see an exception emerging to this. But I think a lot of people who are kind of on like the full reserve camp within the Bitcoin world, they're going to say, well, you don't need notes. Bitcoin can do payments on Lightning. If that system matures, then you wouldn't need to issue notes. We wouldn't have a fiduciary media system ever emerge. So like that's one of the key markets for arguments for like why you wouldn't see a free banking. But to the point I just made, I think that there's probably, if you really start to think it through, there's a lot of other ways I think it could probably come out. And then going back to proof of reserves, that's something that is also complicated. It definitely increases the information transparency. And I think that has a lot of major implications for how we'd see banking build out. Because when we have information transparency, that would create a much more competitive environment for free banking, which is great. And also, it would enable private insurance markets much better. Because right now, so much of our banking system's fucked up by all the perverse incentives of the FDIC.
The FDIC is unfucking believable.
It's I can't even believe it exists.
So,
Yeah.
I mean, look, we have protection in the UK. Your assets are protected in a bank account up to £85,000. Is that correct, Danny?
Something like that, yeah.
So that came out of what happened in 2008. So
Yep.
up to 85,000. Beyond that, you're fucked.
Yep.
Okay, but you're protected up to 85,000.
Yeah.
The problem you've got with the FDIC in the US, I think, is up to $250,000. But the most fucked up thing about that is that it basically gave banks free reign to go and make irresponsible mortgage offers because they knew they'd get the money back from the FDIC. It's fucking ridiculous.
Right. It's a perverse incentive to insure somebody who has a conflict of interest with the risks that they're taking on. That's number one. And then the other fucked up thing is the mechanism that they use is like flat rates for all the banks. So like it incentivizes, it benefits the riskier banks at the cost of the poorer banks.
Yeah.
The conservative banks. And that's the most fucked up part about it. So like we have this public insurance market that's creating all these perverse incentives within the system that you're already dealing with, which is that this is a perfect example of all these arguments. Like when people are like free banking didn't work in like, the US, for example. The US was not great. There were some areas that were okay, but it was heavily regulated. It wasn't free banking. There was like bond collateral laws that they had to keep in their reserves and shit like that. It was not a free banking system. It abided by a lot of characteristics of free banking, but there was heavy, heavy regulation around it. So like when you think about these ways that the government interferes in our banking system and how it creates these bad incentives, that's what's caused a lot of these issues to happen. And bring this back to like proof of reserves, because it'll be so much more transparent within these systems, it's going to create much more transparent markets that private insurance providers can emerge and use for risk analysis, which I think will be really important.
Well, the market figures it out.
Right.
I mean, for me, the FDIC it's essentially a sticking plaster over the consequences of, was it Glass-Steagall that was repealed under Clinton?
Yeah.
Yeah. So they wanted to deregulate the markets. Clinton wanted, I mean, it probably goes back further. That. Clinton wanted more people to have access to home loans because you used to have to like have a 20% deposit, right? And I was like, well, that not enough people have a 20% deposit.
Yep.
Let's get rid of Glass-Steagall. But that had that consequence of lending to money to people who couldn't afford mortgages, and so the FDIC insurance program was a sticking plaster.
Right.
Am I correct? Have I got that wrong?
I'm not like an expert on all of it, but I'd say that that's a fair argument.
Sometimes I mix up Glass-Steagall and Dodd-Frank. I think Dodd-Frank is what came after.
Oh wait, yeah.
Yeah, I'm pretty sure it's Glass-Steagall.
Yeah, it's Glass-Steagall. Yeah. Which, in fairness to Elizabeth Warren, is one of the things she got right. Her analysis of that.
Oh, interesting. I haven't heard it.
You should see her grill Mnuchin on his, before he became, was he Treasury Secretary?
Yep.
Yeah, you should see her grill him on, and especially when she was talking about the repealing of Glass-Steagall. She was good. And I'm hesitant to compliment Elizabeth Warren.
She's the worst, man. I can't stand her.